Hi there guys, it is Friday again. Welcome to another video. Welcome to another topic. Today I would just simply want to explain something about diversifying, about building up a portfolio, diversifying in currencies, and why it is so important to simply have a look at projections, probabilities, and stuff like that. What has it to do with building a portfolio, for example, in stocks? What has it to do with a combination of forex, foreign exchange currencies and a portfolio of stocks? Well, it's quite obvious, it's quite important. If you simply think about the whole market cap, the whole global market cap regarding the stock market, we are speaking about 80, 85, in direction 90 trillion US dollars. So the whole market cap worldwide in stocks is around that. If you look at that whole market cap of, let's say, 85 trillion US dollars, there are a lot of stocks out there denominated in US dollar. So if you simply, from your point of view, from the Eurozone, start with building up your portfolio right now and buying into some US stocks, let's say Amazon, Tesla, whatever you pick out, is simply buy yourself into the US dollar as well. And it's kind of obvious for you that this kind of a currency rate, the euro versus the dollar, is always moving the whole week. And that means that your price, your stock price, is not only moving plus and minus whatever, it is on top moving because of the currency rate. And this is something like an additional risk, a so-called currency risk. Of course, a couple of you boys out there, they are able to hedge themselves against that. But the average investor or trader doesn't know anything about that. And probably a lot of them didn't even hear or didn't even think about that. If you check out data where the US dollar rate and the yields and the interest rates are running to, if you just want to get an information where the whole journey is going to, you may find a lot of informations directly at the Federal Reserve website. So what do? Usually you simply open up the website and check for monetary policy. Monetary policy, there are a couple of PDF files you can simply download. Let's talk about, for example, the last one from December 16th, 2020. You get a lot of information about projections, about economic projections, about GDP projections, about unemployment rate projections, about PCE core inflation projections, and on top of that, you can see projections regarding the interest rate or the so-called federal funds rate. So right now, the federal funds rate is between 0 and 0.25. So that's almost zero. And if you have a look at the future rates or the probabilities of rate hikes, you will see that the whole year 2021 won't be anything like a rate hike. There's nothing like that. Probabilities are running in direction 0 that we will see something like a rate hike this year. So far so good. A couple of other informations you can take away with are, for example, projections for the next years to come. This is important for you because when you start building a portfolio, let's say in stocks, you want to know where the journey is really going to, because you want to simply pick out a couple of US stocks as well, invest in US stocks, and you don't want to be having something like disadvantages simply just for the reason of interest rates and of the exchange rates. So you have a look at the projections further down the road into the years 2022, 2023, and on the longer run. So what do we learn from that? Right now, from today on, we simply have a projection of a Fed funds rate between 0.25 and 0.75 in the year 2022. If we have a look in the longer run, we will see possibly future rates around 1.5 in direction 2.5%. Where do you find this kind of information? On top, between the PDF files and stuff like that on the Fed website, you will see another PDF file downloadable, monetary policy, and you will see a so-called dot plot chart. This is something like very easy, like the name dot plot also explains to you. It simply has a couple of dots, and all these kind of Fed members from the Federal Reserve, from the 12 regional Feds and the rest of the board, all have something like an opinion, of course, about the future or the possible future rates, and they simply have one dot. And one dot and 17 dots on that kind of paper simply give you information about the future possibilities of the Fed funds rate. So you can see there is this dot plot chart, and this dot plot chart gives you information about a possible rate between 1.5 and 2.5% in the year 2023-2024. Kind of implications for the US dollar? Well, if you see inflation going up, you probably may think that the central bank wants to avoid something like destabilizing economies, destabilizing the whole financial system, so they might work against it. So the most important job of the central bank is stability of the US dollar and stability of the US financial system. In the end, that's the world financial system. And if you have a look at that current rate, and you will see an inflation coming around between 1.5 and 2.5% in the coming month, and even until the end of the year or into the next year, you might be scratching your head, what are these guys up to? Will they be tolerating a so-called inflation overshoot? Yes, they probably will. It depends how long they will be able to. But just think about, it's not only the Federal Reserve out there. You are, like me, you are caught with the ECB here. And right now it doesn't look like anything like a rate cut in the next years to come if you just have a look at the current system, the current interest rate scheme here. So you might scratch your head on top. How do they react if there's something around the corner into the next year with inflation? And Mr. Weidmann from the Bundesbank today spoke about a possible inflation rate in direction 3%. So that's a huge overshoot, and they are simply going to tolerate that. The ECB guys, they won't change anything. So what do? This simply is something like another thing burning a big hole into your pocket and stealing your worth of money out of your pocket. If you don't do anything against that, you'll simply have a huge problem. So what can you do? Simply buy into stocks, a kind of a protection, and on top of that, buy into US denominated stocks, for example. Well, if you want to have additional information about projections and probabilities, let's have a look at the CME. So the CME Group is one of the biggest stock exchanges regarding futures and options, located in Chicago. And you will have this website, the CMEgroup.com, where you get information about a so-called FOMC, Federal Open Market Committee, projection. And this is a forecast for the next month to come until the end of the year 2021. And you will see so-called probabilities. Is there anything like a probability of a rate hike this year? No, there isn't. How do you know? You simply check that kind of a tool from the CME website, and you will see until the last FOMC meeting in December 2021, there's nothing like a probability, so-called, that there is a rate hike around the corner. So that means the rate hike is moved forward into 2022, simply due to the fact when you have a look at that kind of projection tool. So-called minimum of a probability of 2% only is talking about is speaking about a possible rate hike. So the probability of 2% is down to 0, so it's worth nothing. 98% is a clear number, won't be anything, won't be any change. What is the conclusion? The conclusion is, if you want to stabilize, if you want to average, if you want to diversify, you simply have to think about not only investing in euro-denominated stocks. On top of that, last week or 1 week before, we spoke about the GBP and Britain, and it might be something on top to diversify. So if you want a so-called diversified portfolio later on, after a couple of months or even after a year you've been building that one, you simply have to think about adding something like British stocks, adding something like US stocks, possibly some Japanese stocks, some South Korean stocks, Singapore stocks. However, how big you want to build up your portfolio. Of course, don't get scared. A couple of reasons to buy these kind of shares is something like going definitely abroad to exchanges abroad, simply to buy these kind of stocks directly in US dollars, in South Korean won, in Japanese yen, or for example in the Australian dollar. Don't buy them at the European exchanges, simply due to the fact because sometimes lack of liquidity is blocking you, blocking you, and it costs a lot of money. Usually the spread is way bigger than the home stock exchange gives you a possibility to step in cheaper. All right, from that point of view today, that's it. Hopefully you will have a great weekend, a sunny weekend, and hopefully you will leave some thumbs up as well for that video. And we will be seeing us next Friday. So far so good. Happy Friday again, and see you. Bye bye.